My name is Mary Colegate, and I thank you for participating in our Take 5 presentation. My section is on UBIT, when is tax exempt, not tax exempt. What I'll go through is kind of an introduction of how UBIT, the IRS started with and put in place UBIT, how UBIT is determined, and then there's some exclusions from UBIT, and then there's special applications of unrelated business income rules, and then some recent developments starting back, going back to the 2017 changes, and then hitting some of the CARES Act changes. Many think that if you're a 501c3 status of your organization, that no federal income taxes are required to be paid. But that's not exactly true. The unifying theme underlying the laws regarding unrelated business income, or UBIT, is simply stated, income derived from activities unrelated to your organization's purpose is taxed as if earned by a comparable for-profit entity. So if you do come across and you do have UBIT income created from some type of activities that your organization will put on, that UBIT income is taxed at regular corporate income tax rates. And calculating UBIT, just like with a regular corporation, you would get normal business deductions that are directly related to the creation of that income. Any depreciation, net operating losses are available to offset any income that is generated in a year. And then you can also deduct charitable contributions made by the organization. The IRS actually allows a nonprofit organization $1,000 exemption up front. So the first $1,000 of unrelated business income is tax-free. In 1950, the IRS determined that nonprofit organizations were generating business income and it was tax-free to them. And so they thought that was unfair, that nonprofit organizations were not being taxed on any type of income. So they instituted and started defining what unrelated business income was going to look like. So the next major change in determining UBIT came from the Tax Reform Act of 1969, which added provisions really intended to make a for-profit and a nonprofit entity on the same wavelength in regards to if the nonprofit was generating unrelated business income that was not tied to their mission. So you ask, well, you have UBIT income, okay, does it matter how much UBIT income I have that our organization is going to generate or has been generating? The IRS says yes, but all they have stated in the tax laws is a substantial amount, but never has defined what substantial amount means. So there's no fixed percentage of your nonprofit income or a mechanical test to determine what is substantial. So through the years, the IRS hasn't come out and said what they have determined, but from tax positions, some private rulings, and from audits that have occurred, the general rule is about 20%. So if your organization is generating UBIT income and it is less than the 20% guideline, then you shouldn't have any issues generating UBIT income that the IRS would feel it would jeopardize your nonprofit exemption status. Now, if your UBIT income exceeds 50%, it would be hard to demonstrate to the IRS that your organization's primary purpose is its exempt purpose, that you're really just, your organization is really a profit motive organization. So if for any reason that you're getting close to that 20%, or you're concerned that your UBIT income is going to affect your tax exempt status, the IRS has stated that you might want to consider taking that specific purpose and setting up a separate for-profit subsidiary, which can be a corporation, it can be an LLC, it can be a partnership, but it would separate and show to the IRS that yes, we know that our organization is creating UBIT income, and we're separating that income so that we can be taxed on it, and it doesn't, we don't want it to affect our exempt purpose. So that's kind of an introduction of how UBIT became into play. So let's now go and define how the IRS calculates or determines what income is UBIT for a nonprofit organization. So a lot of organizations feel that as long as the profits from revenue being generated from those activities are going to support the work of my nonprofit, why isn't that revenue automatically tax exempt? Well, the IRS has stated that it's not what you use the funds for, it's how the income is generated. So to be exempt from UBIT, the income itself must be derived in a course that furthers an exempt purpose. So as I stated, the IRS has put in a three-prong test to determine if income should be classified as unrelated business income. The three prongs are: is the activity a trade or business, regularly carried on, and not substantially related to the nonprofit's exempt purpose? As you can see, I said and what that means, all three of these elements must be in place in order for income to be considered UBIT. So let's take and break down each of these questions and go through and see what questions you or your organization should be asking. So number one, is the income a result of a trade or business? So what the IRS is looking for there is the activity carried on in order to generate income from the sale of goods and services. So does it have a profit motive? Would you find a for-profit entity doing the same activity that your nonprofit is doing? Just remember that when they're talking profit motive, if your activity is creating a loss, that does not mean that you're not going to pass this test of the income being classified as a trade or business. Because unfortunately, we all know that a for-profit entity has losses every once in a while. So the big thing is it operated in a commercial manner? And is your intent to have a profit motive? So there are some exclusions, as I said, in regards to this. The IRS code is widely encompassing. So any activity you're thinking about, you really have got to think about it is in regards to, could it be classified as a trade or business? There is some exclusions. If the income is passive income, then there's a special exclusion. And then the other thing that the other part to this exclusion, it's not written, but the IRS is kind of put out there that fundraising is, they consider that more an administrative or a management function as opposed to being an active operation. So most of your fundraising events should not be considered a trade or business. So the next question is, the trade or business regularly carried on? So what the IRS is looking for there, does the business show a frequency? Are you doing it on a regular reoccurring basis? Intermittent or sporadically throughout the year doesn't mean that it's regularly carried on. When you're looking and trying to answer this question, an annual event like a fundraising event, the IRS is saying, yeah, that's regularly carried on, but we don't consider a fundraising event a trade or business, or doesn't pass the test of frequently and consistently carried on. One-time sales are exempt. Say that your organization is asked to participate in a community event, and you set up a table and you're selling some type of promo item or selling some kind of service, and it's just a one-time event. The IRS is saying that one-time event sales are exempt. Now, you do need to watch advertising. Advertising is an area that can go either way. It depends on what type of advertising that you are doing and how long of a period that you're trying, or your organization is trying to sell the advertising. And in that area, I would contact a professional that you're working with in the accounting area, and just walk through that area in regards to advertising. Sponsorships is another area that can go either way. What the IRS is looking for there, I know that that's a big item for a lot of nonprofits, is, are you providing the sponsor? Is the sponsor that getting any kind of exclusive deal for giving money? Are they are you attaching a link to their website, but that where they can sell items to, if somebody clicks on it, it's not that, hey, your link to their website is just informational, that's fine. But if your link from your website to their website, and you're able to, the person is able to purchase items, then that can cause a UBIT issue. Or if here's an area where you're providing advertising at no cost to that sponsor, can create a UBIT issue. Along with the sponsorships, the things that we tell our clients is, kind of treat your sponsorship as a contribution, like any contributor would be served, and acknowledge it more as a contribution than a sponsorship. And you shouldn't have any issues there. Now we're to the third question. And this is the one that a lot of nonprofits struggle with. Is the business substantially related to the exempt purpose? Does the business contribute importantly to accomplishments that the organization's exempt purpose or its mission, other than fundraising? This is, like I said, the most difficult to analyze, because there's a lot of subjectivity that goes into analyzing this area. Just to give you a couple examples of some private rulings that have come down from the IRS in this area, items that are related. Say that your organization is like a bar association, and you're providing lawyer referral services for a fee, then the IRS has come out and said that's okay, because it's related to your exempt purpose. The selling of educational products that are tied to your mission. That sale, even though you're selling a product, they've said that that's not considered unrelated business income. On the flip side, a couple private rulings that have come down that says that this, even though it's close to your mission or it's kind of tied to your mission, we're saying this is automatically UBIT. Here's one that's the veterinary services. Maybe your organization services the cruelty and prevention of animals, and you provide vet services for a fee for anybody that walks through your door, the general public. Then, because those services for the vet fees would be classified as UBIT income, even though you're still serving dogs, but it's a different purpose. This one is an easy one, but I'm throwing it out here. Liquor sales by veterans organizations would be automatically UBIT because it's not related to what the veterans organization purpose is. So just remember, when you're going through an activity that you're questioning, just go through that three-prong test. Remember, is the activity a trade or business? Is it regularly occurring? And is it substantially not mission driven? And if you can answer those three questions and they're all in the negative, then you probably have UBIT. So on to our next. So what does the IRS automatically say? Does the code automatically exclude from UBIT, no matter how large or how much you earn? Again, as I said, tax code exemptions, it's got to be passive income. So your interest or dividends from your investment accounts, rent from real property. Now, when we get to the next section on special applications, we'll hit back on the rent for real property, because there's some issues where rent from real property can be UBIT. But when you're renting property, you also have to watch if you're also including personal property in the lease agreement. If your personal property rent percentage is higher than your rent for the real estate, then it will automatically taint your rent for the real property and make everything taxable as UBIT income, because renting a personal property is classified as UBIT. The sale of property, when you would sell property like in stocks and bonds in that area, and it's going to create a capital gains, the IRS has stated that the capital gains are exempt from UBIT, and then royalty income is exempt. There are some situations where royalties can be UBIT. That would be, again, an area that you would want to contact a professional and walk through those situations. You need to watch earned income from shares that you own in S corps or partnerships, because if they're not passive in nature, then they can create UBIT income for your organization. Some other exclusions is related to research activities. There's 3 primary exclusions. If your organization is doing research for the United States, that is exempt. If it's done by a college or a university, that's exempt. And that, I should say, if your organization's primary purpose is research activities, then any income that is generated is automatically exempt. If your organization has volunteer based and they come up with an ideal to generate income for you, that income, because it's all generated and it's not using personnel from the organization, that income would be exempt or excluded from UBIT. It's not classified by UBIT. A sale of contributed property. A good example there is a thrift shop. Here in Dayton area, we all are aware of like Goodwill stores, that all of the items that they're selling in their stores is contributed property that they've gotten through, and they sell it and then convert those funds into program purposes. Another would be the St. Vincent de Paul, does kind of the same thing. And near and dear to my heart in Dayton is a foundation, that an organization, Close It Works, that takes any of the clothing that is donated, and it doesn't have a business purpose for their recipients. They put it in a thrift store and they sell those items to generate funds to buy business attire. Activities for the convenience of members, employees, primarily for the convenience of its members, students, patients, officers, and employees. Some examples here are restaurants, like your hospital restaurants, or gift shops in a museum, parking lots that are for your patients, where your patients or people coming in to visit patients don't pay anything, or they pay a nominal amount to park, or laundries, where like at student union halls or something like that. That income is automatically excluded and not classified as unrelated business income. Trade shows, the actual rental of the display space or exhibitors, two exhibitors, that would automatically be excluded. Bingo, games, and charitable gambling. Now, in general, this is tax exempt. You do have to look at your state laws in this area, and then who's generating the income. This is an area where if you can get volunteers to do your bingo games, then you're safe. Rental of mailing lists from one exempt organization to another. Or another good example is when you're soliciting funds, that you're sending a low cost item like a coffee cup with your logo, or some other trinket that has your logo to a contributor, then those are all tax free. So, as I said, there's some special applications that relate to unrelated business income. And the biggest issue here is when you have debt financed income. So say that your organization buys an office complex, but the office complex is bigger than what you need, so you rent out space to either another nonprofit or just to the general public. The things that you need to look at is if the building was debt financed, or say that you improved the building and you acquired debt for the improvements, then when you rent out the space, then it becomes can create a UBIT situation, depending on after you take the rental income and you apply the normal rental, like a normal renter leaser agreement allocation, you could create a UBIT issue. But if that same building and you bought it and you didn't have any debt financing and you were just renting space, would not create a UBIT. It's because it's been financed that the IRS now says that you're a leaseor like a business. If you do have debt financed property and you go ahead and you sell it, any gain on that sale is also classified as UBIT income. There's a couple exceptions to debt financed income in the area of neighborhood land projects. A good example here is like Citywide that goes in and revitalization projects that even though they might have debt on the land, they would not have any kind of gain, or it wouldn't create, if they leased any of the property, they wouldn't have any UBIT to worry about there. Real estate owned by qualified organizations, which are educational institutions like your schools, employee benefit trusts, and certain title holding organizations. And then again, research activities are exempt if they're debt financed. The other special application of UBIT is that an organization can have a situation where they go through that three-prong test, and maybe it comes down that they have an activity that can be classified, or it needs to be fragmented. And part of it could be classified as UBIT income, and part of it is really related to their mission and doesn't meet that three-prong test. A good example of fragmentation comes down to is how is the income being generated? One example that I can throw out there that kind of gives what the IRS is looking at is like in a parking garage. Say that you're an arts organization here in Dayton, they own a parking garage. So they do charge a fee the nights that productions are going on, and so that the people that are attending can park, and they charge maybe $5 to park. So that income, because it's related to the production, because they wouldn't have that production income if they didn't have the participants. So that parking income would be exempt. But say that same organization is allowing monthly parkers or daily parkers, just the general public, they would have to fragment that parking income, and anything related to the general parkers or the monthly parkers would be UBIT, but the parking income related to when they're doing productions would not be UBIT. Another good example is a cafe that's within a museum, where it's there for the convenience of the people working and the people that are visiting the museum. But say that that cafe has a door to the outside directly that the general public can come in and buy food and sit down and have a meal. They would have to fragment that income, because the general public that's coming in just to eat lunch aren't there, they're not participating, or they're not going into the museum. So that income would be UBIT. But if somebody that's attending or the staff is buying meals at the same restaurant, those would be exempt. So there are situations that you have to watch, that you could have a combination of UBIT and not UBIT. As I had stated earlier, when you think your organization might have concern about your exempt status being jeopardized, creating subsidiaries, which can be set up, and those subsidiaries would be taxed whatever income they generate, but any of the income or the cash moving into the nonprofit wouldn't be taxed again at the exempt status. So I'm hoping that has helped give you some clarity to how the IRS determines UBIT and activities that you might look into or need to question when you start a new activity fundraiser. So some recent developments, as I stated, the last big change was back in 2017, the Tax Cut and Jobs Act. This is where the IRS decided that you couldn't take all your UBIT income, no matter how it was generated, and you just, before 17, you just put it on your 990T and you reported it, and if you came to a loss, then you were okay. You didn't have to pay any tax, just like a for-profit entity. Well, now the IRS has decided that nonprofits should silo, which means they have to divide their UBIT income up into business categories by the NAICS code. So what that's saying is, say that I have that parking garage and I have the cafe and I'm selling some kind of product. I'm still only doing 990T, but I have to track my income by those silos. And if my parking garage has a loss and my cafe has income, I can't take the loss from that parking garage and offset it against my cafe income. So that was a big change. And then with the Tax Act of 17, they put guidance just like they did with for-profit. You could only use 80% of your NOL against any kind of income. But the CARES Act came through, and it has, just like for for-profits, you can carry back NOLs 5 years, and then they have eliminated right now or repealed the limitation of the NOLs. So if you have income and you've got an NOL large enough to zero out that income, you will not pay tax instead of having that limitation of the 80%. The other thing that I just want to throw out to the audience is in regards to, we've heard rumors that the IRS is going to start auditing nonprofits. It's probably going to start with the larger nonprofits where maybe UBIT is a question, and maybe they think that organizations have activities but not reporting them as UBIT income. So we do see that that's going to come down the pike, and we haven't had in years had a nonprofit being audited, but I think we're going to see more of that coming down the line. So I want to thank you for listening, and like I said, I hope this brought some clarity to why tax-exempt organizations income might not be exempt. Thanks.
All right, thanks, Mary. That was a great presentation.
Thanks, Dylan. I hope it was informative to the group.
Well, we had some questions roll in throughout the presentation, so we'll go ahead and get started then.
Sounds good.
First question we have here is, the activity we are carrying on has resulted in a loss. Do I need to be concerned with UBIT?
Well, that's a question is part of the three-prong test that we went through. Even though you might be generating a loss from an activity, the thing that you need to look at more than just the loss factor is if the business is being conducted in a commercial manner. But remember that you have to meet all of the three-prong tests to make it UBIT.
Okay, perfect. Next one we have is how much unrelated earned income may our nonprofit receive?
Well, as I had mentioned in a nutshell, a nonprofit can make the first $1,000 of UBIT income is tax exempt. And then after that, there is the tax. But I think the bigger question here, maybe that they're asking is, hey, how much can my nonprofit earn and not affect my tax exempt status? As I mentioned, the unwritten rule right now is about 20% of your income is UBIT income. You're still probably okay, and it won't affect your tax exempt status. But if you start creeping up and you get up to that 50% margin, then I would be concerned that, and I would start looking at, hey, is this activity could it put me in my exempt status into jeopardy?
Okay, perfect. Thanks. Next one we have. So are there criteria for the differences between contributions and sponsorships by businesses? Like maybe displaying a name on a poster or t-shirt or putting a logo on a website or social media?
Well, there's not real criteria. I guess the biggest issue you've got to look at to make sure your sponsorships don't become UBIT is that you're not doing something special, that you're not, if you're putting a link on a website from yours to theirs, that it's not going directly to where they would be selling an item that it looks like your organization is supporting their sales. But a general display of a name on a poster at an event, thanking them, or putting like on a run or something like that, fundraiser where you're putting logos on a t-shirt for thanking them, still would be classified as non-UBIT income, wouldn't be generating non-UBIT income, and that sponsorship you shouldn't have any issues with. It's where you're giving that sponsor something extra that you wouldn't maybe give to a regular donor, may jeopardize that sponsorship money.
Okay, great. Are there any activities specifically excluded from the definition of UBIT?
Well, as I mentioned, as long as it's passive in nature, like your general like interest and dividends and that. But I think the bigger thing to look at are those activities that that are ran by volunteers where the organization isn't paying those volunteers to generate that money. So any of those activities, fundraising activities, operated would not be included in UBIT. Some examples might be operating a bake sale, or in the area of bingo, if the bingo or is ran all by volunteers, then that income that's generated from the bingo would be exempt. Another one is convenience of your members. Say that you've got a cafeteria is a good example, like in hospitals or in a university that is there for the doctors, the nurses, or be it the teachers or your students, then those items would be exempt. Or selling donated merchandise, as I had said in the presentation, would also be exempt. And then again, depending, like with thrift stores or operating, would be definitely exempt from UBIT.
Excellent. All right, we have a couple more here. So what if we have debt on the property, but we lease space to other nonprofits? Would this be taxable income?
No, it shouldn't be. I know that we have some organizations here in the Dayton area where that they are renting space, maybe for practices or just in general, they're housed in the same location. But if you're running to a nonprofit, that should not create UBIT income.
Perfect. All right. So related to the likely increases in audits of nonprofits, are all years of existence fair game, or is there an estimated number of back years to expect?
We haven't seen many audits come through, but I mean, if they find, kind of like in the business arena, that there's a 3-year period, but if they do find something and it's not following your exempt purpose or what your original 1023 with whatever modifications that you put the IRS on notice that you've made could come into play.
Excellent. All right. Just wait one more second, see if we have any more questions coming in. Otherwise, I think we'll end up heading back to the exhibit hall and then back for our kind of second half of our presentation here.
Okay. Well, I appreciate everybody attending, and I'm hoping that the keynote speaker was an excellent, she gave out a lot of excellent information, and I know that our feature speaker should be just as good.
Perfect. All right. Well, with that, I think we'll go ahead and conclude, and we'll see everybody in the second half.